Good afternoon, everyone. Thank you for joining us. Welcome to the final dialogue series of the year. I'm Anjal from the AASB. The dialogue series is held jointly with CPA and CANZ, and the purpose of the dialogue series is to gather preparers, users, auditors, standard setters, and other stakeholders to share views and learn from each other. The topic for today is making materiality judgments in financial reporting. Today's session will be chaired by WSB Research Director, Dr. Eric Lee. We will have a presentation followed by a panel discussion. Please note that the views shared in this session are not the views of the presenters' organizations, but it's their personal views. Also, you are welcome to ask any questions using the Q&A function in Zoom. We will try to answer as many questions as time allows. With that, I'll now hand the session over to Eric.
Thanks, Anjal, for your introduction. So good afternoon, everyone. Thank you for joining us today. Perhaps let me quickly provide some background of today's topic to start the presentation and the panel discussion. Especially, I think it is important to put this in the Australian context. It is important to note that the materiality concept isn't new. The concept was considered and developed many years ago. I actually had a quick recap on the history. In 1969, before the AASB was established, the Institute of Chartered Accountants in Australia issued a statement called Statement D7, the interpretation of material in relation to accounts. That statement provides guidance on the concepts and the application of materiality. And then in 1974, the Australian Accounting Research Foundation, which was the considered equivalent standard setters as the AASB, but before the AASB was established, issued the Statement of Accounting Standards number 5, Materiality in Financial Statements, again with very similar objectives. And then in 1995, some of you may still remember, the AASB issued AASB 1031, Materiality. And then in 2005, Australia adopted the IFRS accounting standards. The AASB, however, retained the AASB 1031 because at that time, the AASB wanted to ensure that the meaning of materiality remained well explained. And then exactly 10 years ago, in 2013, the AASB removed AASB 1031 because the IASB issued a revised conceptual framework on financial reporting, which contains updated guidance on materiality. And then in December 2017, the AASB then adopted the IASB's Practice Statements 2 to provide more clarity on making materiality judgments. And it's been a very important document to help preparers and users to understand the concepts. So in summary, standard setters and the accounting profession have been applying the materiality concept for many years, over 50 years. And I think it's also worth mentioning that this is not just an Australian case, it's also similar to many other jurisdictions such as the UK and New Zealand. And so ultimately, the concept of the term materiality generally hasn't changed. It emphasizes the importance of having the information recognized, presented, and disclosed that truly meet the needs of general purpose financial statements users for decision making. However, there always have been challenges. And so today we're going to explore this topic. And it's very important to caveat that this discussion today are perspectives of individuals, of the presenter and also our panel members. As mentioned, this is not an easy topic, and we are pleased that they have agreed to kindly share their insights and experiences. The views are not intended to represent any groups or provide solutions, and we recognize that there are many different views among our stakeholders groups. So to have a focused discussion today, as the title indicated, the boundary of today's discussion is on the materiality judgments for a general purpose financial reporting. And some of you may ask, what about sustainability reporting? Now, I don't think 16 minutes can justify a good discussion on that topic. And also many of you are aware that the AASB released an exposure draft, SD1, which is on the disclosure of climate-related financial information. There will be lots of opportunities, including a series of outreach activities for you to provide feedback in the next few months on that topic. So please subscribe to the AASB weekly updates for LinkedIn and also for any updates. Okay, I think I've spoken enough, and now I'd like to hand this session over to Tom Freak, who is speaking to us from the UK at the moment. Tom recently published a research paper, a double SB research paper on this topic with Professor Michael Darvin and Associate Professor Brad Potter from the University of Melbourne, in responding to the IASB's call for research on materiality. Tom had worked in academia, Big Four firms, and also standard setting. And Tom, thank you for sharing your research, and I'm now handing this session over to you.
Thank you very much, Eric, and good afternoon, everyone, or it's a very fairly early good morning for me. Let me share my slides with you. So as Eric said, this research was done with my colleagues at the University of Melbourne, Michael Davin and Brad Potter. And in this research, we took the view of looking at the impact of IFRS Practice Statement 2 on the audit profession and the way that auditors make materiality judgments. This research was some follow-on to some prior research that we had done looking at materiality from an investor perspective. And then we broadened our scope to also look at auditors. And as Eric said, this was in response to a call for research from the IASB and AASB around the impacts of Practice Statement 2. So we do have to thank the IASB in particular for their help in helping us source research participants and in helping to access auditors to be able to conduct our study. So to start off with materiality, as Eric said, it's a concept that's been around for a long time, but we find that in academia and in practice, there's still quite a varied level of understanding about what the concept is, and there's a lot of different ways that it's applied. So I thought it'd be a great way to start with the definition of what are we actually looking at with materiality? What does the concept do in our accounting system? And we've got the definition there from the conceptual framework. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions of our users of financial reports. So it's a pretty basic concept at its core. If information would impact the decisions of users, that information should be disclosed to users. If it wouldn't impact decisions, it's not material and it shouldn't be disclosed. And when we think about materiality in this way, fundamentally, it's a concept focused on users of financial reports. And it's a way that sometimes we don't conceptualize and think about materiality, that it is primarily a very user-driven concept. Where we see the tension in materiality in its application and in prior research is that while it's a user-focused concept and it's very important for us to disclose information that is useful for users, it's applied in practice by preparers and auditors. When preparers and auditors are preparing and auditing financial statements and financial reports, they are the ones that are having to make materiality judgments and decide what information is actually disclosed in a set of financial reports. So we can almost think about preparers and auditors as being there to proxy for the materiality judgments of users and decide what information is important for users and might impact on their decision-making. When we look through research, which has been going on for many decades now into materiality, particularly on the audit side, we see that auditors and preparers often make materiality judgments that are very heavily informed by what we might call percentage-based heuristics. So looking primarily at the quantitative elements of financial statement line items and information in financial reports, and often making materiality judgments using quite simple rules of looking at one of the important line items in the financial statement, take sales, net profit, total assets, taking a percentage of that number, whether it be 1, 2, 5, 10%, and using that as a threshold for whether another line item is material. So if I've got a line item on a particular asset, I might look at whether that asset is 1% or 10% the size of total assets, and that will tell me whether or not it might be material, and that might tell me whether or not it should be disclosed in reports, and whether it's important from an audit context. Now, while that might be a relatively easy and straightforward way to judge materiality, the more limited research that looks at user decision-making and how users make materiality judgments shows us that those materiality judgments are rather more complex and rather more nuanced. From a user perspective, there's generally a very broad range of information cues that they use, both quantitative and qualitative in nature. And users often don't look at single line items in financial statements or single pieces of information within the financial reports in isolation. Usually they're taking different information cues, putting them together in the context of the firm they are looking at, and developing a kind of story or narrative about the firm that they're considering investing or lending with. So we see that there is this difference in the way that materiality judgments are made, and potentially that's where we see some of the tensions and some of the issues arising with the application of materiality. As Eric said, Practice Statement 2 was released by the IASB in 2017. It's important to note that it only provides non-mandatory guidance on making materiality judgments. It's not a standard in itself that must be followed. And Practice Statement 2 is primarily aimed at preparers, but it can also be useful for auditors to be aware of and to make use of as well, to understand materiality judgments that might facilitate the disclosure of decision useful information for our financial report users. If you're not familiar with the practice statement, very briefly, what does it actually say and what kind of materiality judgment process does it prescribe? It's a fairly basic 4-step process. So firstly, for a firm and for preparers, you should identify a set of potentially material information, which you can almost think about as a set of relevant information. The majority of the guidance is within step 2, so assessing whether that information is material by assessing any relevant quantitative factors, qualitative factors, and any potential interactions between those factors, and drawing very heavily on the context of the firm that the assessment is being made for. Step 3 is around organizing and presenting material information. And step 4 is reviewing whether information is material both individually and in combination with other information presented in the financial statements and the broader financial reports as a whole. So this 4-step process for materiality resembles a bit more what the research shows us a user process when they're looking at materiality. It's very heavily dependent on the context of a firm, and it's using the specific information available within a particular firm to make those materiality judgments. So it's very clear that information or a line item with a particular set of numbers that is material for one firm might not necessarily be material for another firm. So with this research, we're aiming to look at if Practice Statement 2 has influenced the decision usefulness of auditor materiality judgments for financial report users. So looking at whether that 4-step process has changed the way that auditors have potentially made materiality judgments, and are they more useful for our users of financial reports? And there are 2 elements or dimensions through which we've tried to look at, are these materiality judgments more useful? Firstly, we looked at whether the practice statement has influenced the consideration of quantitative factors, qualitative factors, and the interaction of these factors in order to materiality judgments, rather than perhaps the traditional view of primarily looking just at quantitative factors. And secondly, looking at if the practice statement has influenced how auditors specifically consider the information needs of report users in making those materiality judgments. So 2 dimensions here, which the practice statement encourages preparers to look at when making materiality judgments, and potentially have had an impact on the way that auditors are making those judgments as well. In order to test the research question, we set up an experiment and had 42 experienced auditors complete the experiment. This was a very international sample with auditors responding from across Oceania, Asia, and South America. And again, we have to thank the IASB for their help in sourcing the international auditors from Asia and South America in particular. While we didn't have a huge sample size and huge number of participants in this study, we did have a fantastic level of quality of data that we collected. The auditors that we had respond to this study had an average of over 20 years of experience in audit. I'm sure the researchers on the call here will know the joys of trying to get auditors in particular and research participants to be able to complete the study. And the majority of these were at the director or partner level within their audit firm, a mix of Big 4 and non-Big 4 auditors. So the participants that we had were people that have had a whole career of experience in the audit industry and have been through all the different stages of an audit across their career. Being at the director or partner level, they're also the people that are often signing off on audits and have responsibility as a lead partner or a lead engagement partner on an audit. So these are the people that will be making materiality judgments and working with their clients to make those disclosure decisions for what information is finally delivered within a set of financial reports. So we asked these 42 participants to complete a basic audit task when they had to judge the importance of a misstatement to a line item in a fictitious client's financial statements. We provided our participants with a set of financial statements and some qualitative background information relating to the firm that they were analysing. So they had a full set of information with context about the firm that they were looking at, so they could make that context-specific materiality judgment. The misstatement that we gave them was to the line item of employee wages in the income statement. And we manipulated that item so that it was a bit of a grey area for whether or not the item would be found to be material with the misstatement. So going back to the idea of a percentage-based heuristic and looking at the quantitative elements of the information, we deliberately set the item so that it had a very small quantitative change. So it wouldn't meet some of our regular percentage-based thresholds of being a 5 or a 10% change. So while the quantitative information looked maybe not so material, we also seeded in some qualitative factors which showed that this firm was expanding and they were hiring new employees. So it would be logical to expect that the employee wages number should actually be rising and rising quite significantly based on the context of the firm. So some tension and some grey area there for whether or not the auditor would find the misstatement to be material based on the different information cues that they used. So we asked the participants to look through the information, judge the materiality of the misstatement, and importantly, explain to us how they made their materiality judgment. We weren't so interested in the materiality judgment itself that the auditors made, but more so on that process of how they made their materiality judgment. We took those responses and coded those explanations of the materiality judgment according to whether we felt they were useful for user decision-making on the two elements or two dimensions that I touched on earlier. So whether they used a range of quantitative and qualitative information cues, and whether they specifically talked about the information needs of report users. We also asked participants to tell us how familiar they were with Practice Statement 2, and to make sure that they actually were familiar with Practice Statement 2, also to briefly outline some of the content and guidance contained within the Practice Statement so that they had a strong understanding of what was contained within that guidance. So to jump to our main results, which we can see in our regression table that we've got here, across our two elements of decision usefulness, we did find some fairly strong evidence that auditors more familiar with Practice Statement 2 were more likely to consider that range of quantitative factors, qualitative factors, and interactions of those factors when they judged materiality. I've included just a couple of responses here down the bottom of the explanations that some respondents gave on how they judge materiality. And the first one that we see there from respondent 39 is a great example of that consideration of a different range of factors. We can see the respondent there is touching on the quantitative information, looking at the year-on-year decrease within that financial statement line item, but they're also touching on the background qualitative factors and the context of the firm in looking at, well, the firm's hired new executives, they're expanding, and we're expecting that wages should actually be increasing. So the interaction of these quantitative and qualitative factors is making them question the information that we're seeing there. And that respondent also told us that they felt it was a material misstatement that needed further attention. On our second element of decision usefulness, on considering more particularly the information needs of users, we didn't find any direct evidence of a link there with more knowledge of Practice Statement 2. And indeed, we did find a lot of auditors followed a materiality judgment process, which was very focused on more audit processes rather than considering the information needs of users and more thinking about the mechanics and processes of the audit. And you can see that with the bottom respondents' response there. They're looking at primarily some quantitative factors there, applying that percentage-based threshold of 5% of profit, and talks more about conducting further analysis. Range and variation in the way that auditors made materiality judgments. In the interest of time, very quickly, we'll touch on some additional findings that we also found, and feel free to read about these further in the report, which is available to access from the AASB website. We asked our respondents how comfortable they were in making materiality judgments in their day-to-day audit role. And somewhat surprisingly, we found that 40% of these respondents said they weren't comfortable to make materiality judgments. We found that quite surprising when you consider that our sample is 20 plus years of experience in audit on average. And these are directors and partners in audit firms. So these are people which we would probably hope are comfortable in making materiality judgments based on the experience and the role that they have within their audit firms. We found that Big Four auditors, compared to non-Big Four, were more likely to rely on quantitative factors and follow more of that percentage-based view to judge materiality. And the biggest sources of guidance to make materiality judgments were guidance coming from the audit firm and previous year work papers. So a few elements there showing us more of that mechanical, traditional quantitative focus on materiality, but absolutely a big variation in the way that materiality judgments are made and those different processes that are followed. We also did ask some questions to figure out how well known Practice Statement 2 is. So only half of our participants were aware that the practice statement existed, and only just over a quarter could actually explain any of the content contained within the practice statement. So putting these findings together on this slide particularly, we feel that it shows there are a lot of opportunities for further education in the materiality space. So first of all, around Practice Statement 2, we've got some good evidence that it does have an impact on how materiality judgments are made by auditors, but not that big a portion of the audit community seems to be aware of the practice statement and its content. So absolutely a role for education in putting out the message of what's contained within the practice statement. But also more broadly, I think it shows that the work on materiality from standard setters and from the accounting profession is not quite there, and it's not quite finished yet. Materiality is still an area where a lot of people have uncertainties. There's still a big variation in the way that materiality judgments are made. And unfortunately for Eric maybe and others, it's going to continue to be an area that sees additional work and additional discussion in the future. Probably a good thing for academics, though. There's plenty of research papers to be written out of this. So to finish off the main implications of the study, so we found that Practice Statement 2, there is some strong evidence that it can improve auditor materiality judgments through that dimension of considering a broader range of relevant factors to making those judgments. Absolutely, there are opportunities for more education for the audit community around Practice Statement 2 and making materiality judgments in general. Like I said, materiality continues to be a concept with a varied level of understanding. It's going to continue to be an area of discussion in the future. And while our discussion today might be focusing on financial reporting, worth noting, and some of our participants did touch on the fact that it's going to remain a more relevant issue in the future as we move towards the context of sustainability reporting as well. But I'll leave it there for now. Thanks very much, and I'll hand it back to you, Eric.
Thanks, Tom. That's certainly very relevant research for the AASB as well, for us to consider what we can do better for our stakeholders in terms of the education piece. So we're now going to move on to the panel discussion. And if anyone you have any questions for Tom or the panel discussions, please feel free to use the Q&A functions while we're having the discussion. So I would like to first introduce one of our members, Rachel Poo. Rachel is the head of Group Statutory Reporting and Accounting Policy at QBE, and she leads the group's external financial reporting. She is also responsible for monitoring potential accounting and reporting developments and assessing their potential impacts for the group. She has many years of experience in the insurance sector with a focus on general insurance, and before she joined QBE, she worked in Big Four firms, Deloitte in London and also Sydney. Welcome, Rachel. The next person I'd like to introduce is Marina Michalitz. Marina is a senior project manager at the AUASB. She is responsible for the planning, research, development, outreach, and delivery of auditing and assurance standards, related guidance, and bulletins forming part of the AUASB strategy and corporate plan. Marina has worked on many projects, and then now including she's working on sustainability assurance. Before she joined the AUSB, she held some senior positions, including group financial controller for a listed entity, and also worked in Big Four firms as well. Welcome, Marina. Next person I'll introduce is Steve Bali. Steve is also a preparer. He joined BHP in 2017. He has many years of experience in audits across the UK and also Australia, and is now the BHP's Head of Accounting Policy and Sustainability Controllership. Welcome, Steve. And the last person I'd like to introduce and welcome is Richard Fakri. Richard is one of our members of the Users Committee, and he is the portfolio manager of the Cromwell Phoenix Opportunities Fund and a research analyst across all of the company's products. Before he joined Phoenix, Richard worked in a variety of roles at MLC and BlackRock, and was part of the BlackRock investment team from August 2006. So welcome, Richard. So what we have here today is we have preparers, we have users, and we have auditors to talk about this materiality concepts and the challenges you may have faced in the practice. So perhaps the first question I would like to ask is from the preparer's perspective, Rachel to start with, and then Steve. The question is that, the IASB currently has a project to improve communication about financial information, about climate-related and other uncertainties in financial statements. And that project also reminds preparers about disclosing material information. Now, as Tom mentioned before, quantitative materiality judgments, that's quite straightforward. Usually there's a threshold, look at quantitative, and then they can decide whether it's material or not material. But the real challenge is on the qualitative materiality judgments. So I would like Rachel to share your challenges and lesson learned in making materiality judgments, especially when information is quantitatively material, but qualitatively material.
Thanks, Eric. Yep, very happy to share reflections. I think when making qualitative materiality assessments, it can sometimes feel a little subjective. And I think, Tom, you said this as well, is because a lot of that, especially when amounts are not quantitatively material, can be very context dependent. And part of that context is the external environment, right? Which could mean that something that could make a particular judgment material in one period may not be the same in the next period. Like COVID was a really, really good recent example of that, where COVID went from a daily headline to endemic, and there was a period of time where there was complex judgment required around when those uncertainties were low enough to stop warranting specific disclosure, even where it no longer had a quantitative impact on the amounts actually being recognized in the financial statements for that period. And in the market, we saw different practices as well, depending on the context of the particular companies and industries. And so each company would have to make really specific judgments. And that is inherently subjective, I think. And that was definitely one of the real life challenges that we've gone through. I think the other thing that comes to mind as well with your question is around how these sorts of materiality assessments are considered in the context of levels of aggregation. So to give an example, and I'm going to put my insurance accounting hat on with IFRS 17, the eligibility to apply the more simplified accounting approach is assessed at a group of contracts level. And the standard requires us to measure the difference between two measurement models for that group and determine if that's material. Say the difference is significant in the context of that group of contracts, but the portfolio class of business is not material for the entity overall. What does that mean? Does that mean you can still apply the simplified accounting approach? And there are quite a few different views and opinions on this as well. And practice statement 2, I would argue, suggests that we should be considering the entity overall materiality in making that lower level assessment as well. But again, as I said, we've come across different opinions on this in the market. And I think you talked about climate in financial statements, right? This could be, in my view, a potentially relevant consideration for that, because say, for example, we have a small portfolio of contracts that's exposed to particular climate risks like transition risks, but then the portfolio is not actually material at an overall entity level, then it becomes very judgmental as to what and to what extent disclosure would be expected. And practice statement 2 is really helpful in terms of the examples. And I know there is one that says in certain circumstances, lack of exposure could be material in itself, could be material information for disclosure, depending on circumstances, context, and users' information needs at the point in time. But that doesn't really take away the need for judgment, and the judgment is very entity specific. So I think that's probably where most of the challenges lies, in the inherent judgment and subjectivity and context-specific nature of qualitative judgments.
Thanks, Rachel. And Steve, what about from your perspective, from mining industry?
Yeah, no, and thanks, Eric, and yeah, happy to share, and I think I would echo a fair amount of what's already been said in terms of the subjectivity and the entity specific question. I think I would also start by coming back a little bit to, I absolutely think that the quantitative assessment has its place, and we shouldn't forget that. And I almost use it as a bit of a rebuttable assumption in terms of we define a threshold, and at least if it's above that threshold, there's a rebuttable assumption that something is material. And I think there are situations where we would rebut that and decide that things aren't. And we're now talking about the things that don't hit that threshold, and then how do you consider them? I think what is interesting is when you come back to the what's material to the users, and the challenge of how, as preparers and auditors, how do you engage with users to understand what that actually is, particularly in evolving areas? And I'll maybe come back to climate in a second on that, because I know it was touched on. I think we've brought COVID up as an example, and I think, again, that was a really interesting time in terms of a couple of ways and a couple of things around materiality. So I think there was a period there where it would be reasonable to assume that most companies, most operations were having a significant impact of some sort from COVID. And the nature of that impact was of use and interest to users. Now, in a lot of context, and as you say, mining, very long life assets, does a COVID, even if it lasts 2 years, 3 years, 4 years, how much does that affect the long-term fundamentals of the organization, and therefore the long-term investment decisions that users are making? However, certainly in terms of impact on shorter and medium-term returns, it's an area of interest, and therefore you would pretty quickly go to it's qualitatively material to give the information about what the impact is and has been. I think the really interesting thing when it came to COVID is the actual direct impacts that hit your financials were only a portion of the story. So yes, we all had costs around additional health procedures, additional accommodation for us, things like that. But the opportunity costs, or the missed revenue against budgets, or what you would have generated without it, is a more difficult message to convey within the context of the financials. So you've got to apply judgment about how do you do that, where do you tell that story in the broader reporting suite, and then to the point Rachel made, when does it stop being at what point do you stop making specific disclosure about it? Very quickly on the climate one, and then we can sort of come back to anything. I think the interesting thing on that is it's such a rapidly evolving space, climate and sustainability, that actually understanding the information that is important to users is quite challenging, because there is the risk of swamping, not being able to see the wood for the trees, over supplying information because it's difficult to ascertain exactly what is material information, and that is very much a qualitative judgment at this point in time. And I think engaging with users and investors is important on that. But I think even a lot of that, and we might hear some from a user perspective, but a lot of that in that space is still developing as to what actually is the useful information that we want, and therefore we're sort of users, preparers, auditors are all sort of growing together in some of those areas in terms of what actually does form material information.
Thanks, Steve. So I think Rachel and Steve, you both mentioned about your COVID-19 experience as preparers, and you did mention about in that period of time, it was quite difficult to decide what information should be provided to users. So we're lucky we have a user here, Richard. A question to you is based on Rachel and Steve's comments about their COVID-19 experience. What was your experience as a user of financial statements during the COVID-19 pandemic? That is, did you get enough information for decisions, and is there any other information you were looking for but not in the financial statements?
Maybe kind of focusing on the June 2020 financial statements, which is kind of the peak uncertainty period. In general, I thought the impact of COVID was generally well disclosed. Like, most companies gave a pretty extended explanation of how kind of work practice had changed, how business footprints had changed, effect on suppliers, customers, in some instances, what efforts the company was making in the community. When it came to kind of specific notes on items impacted, receivables, credit loss notes, they were generally kind of pretty good. Probably kind of, if there was one area, and I think probably the reason for this was because it's somewhat contentious, the thing that probably was not uniformly well disclosed was kind of the impact of JobKeeper or other kind of similar kind of support payments. And that's probably a similar theme kind of generally when it comes to disclosure. It's always a challenge for companies in cases where perhaps they don't want to disclose information for competitive reasons. That could be kind of like a similar reason why information is obscured or material disclosures kind of aren't kind of made. Kind of in some cases, not getting the detailed disclosure on support payments, I guess it just made it very hard to normalize expenses for the next year. And I think that probably subsequently got better over time. I think there was a bunch of kind of requirements subsequently to disclose that information. So eventually that was disclosed in full, but certainly not in the March 2020 financial statements.
Thanks, Richard. Now, Marina, from the audit perspective, again, let's look at the COVID as a case study, given that everyone's talking about COVID at this stage. Whatever from an auditing perspective, did you hear any concerns or any feedback about auditing issues on the disclosures related to COVID pandemic during the period?
Thanks, Eric. Yes, well, at the time, obviously, the AUASB thought it would be important to issue a bulletin just on this matter. And obviously, when the auditors think about materiality, it's very much entwined with the risk assessment. So the auditors obviously do their own risk assessment to determine where they're going to focus, their time, and obviously that's combined with the materiality assessment. So the auditors in COVID, I guess, were also focused on the entities' appropriate risk assessment themselves on COVID-19 and the impact on the entity and the financial report, including reassessing the appropriateness of going concern basis of accounting, whether the disclosures in the financial report were sufficient, and if not, what the implications for the audit report there may have been, and any other areas like, costs to do with, employees not being able to travel and borders being shut. And obviously, we also put out with the AASB in 2019, and it did specifically link to practice statement 2, a climate-related and other emerging risk disclosures assessing financial statement materiality using practice statement 2 back in 2019. So that was able to be applied for a pandemic that we didn't know what was happening when we wrote the guidance, but obviously that's applied, and obviously that's then also being used very widely for the climate areas as well.
Thanks, Marina. So I guess that one of the common themes from the discussions was that, yes, there were a lot of challenges what to disclose in the COVID period. And one of the challenges was that you can't actually predict what's going to happen in the future, right? Because we don't have a crystal ball to determine what's definitely going to happen. And because of that, there's so much uncertainties. And that includes forward-looking information. We have, as accountants, these days we have to think about forward-looking information. Is in some of our standards. For example, when we're thinking about expected credit loss model, we got to think about forward-looking information to incorporate it into our expected credit loss model. And also, when we think about impairments, we got to think about growth rates, and if there's any forward-looking information should be considered in the cash flows predictions. So with that, I guess the first question that I have on this topic, forward-looking information, start with Steve and then Rachel, is what are the challenges you have in practice of disclosing forward-looking information? And is there any practical suggestion to overcome the challenges? Now, give you examples. Is that we see a lot of forward-looking information in the OFR, which is the management commentaries, but they may not be disclosed in the financial statements. Is that something that you have encountered in the practice, Steve?
Yeah, no, I'm happy to talk again to that. Look, I think, and you're right, sort of impairment, and again, we'll come back to sustainability, climate. There's a lot more sort of heading in that direction. I mean, I think the obvious, challenges are the level of uncertainty to start with, and that just brings inherent nervousness, particularly around those of us who are maybe less used to doing it and are more grounded in years of experience of predominantly doing historic and sort of actual disclosures, and that level of uncertainty brings an inherent level of nervousness. I think that brings a level of nervousness to the preparers, including the directors, in terms of what are the potential implications of then the world not turning out as we've expected it to, and disclosed based on what are our exposures there, what are our potential liabilities, and understanding that environment fully in terms of, and what are the protections around it. I think the other sort of obvious but key challenge that you have is around commercial sensitivity, and what have you and haven't you already disclosed to the market in terms of strategies or new product lines or changes in the business organization, and to the extent that they're out there, it makes the providing more context and disclosure to those easier than something that's in your internal planning and risk assessment, but isn't yet sort of more publicly known. I think one of the interesting ones you've got is, and just a couple of points, and I'll let you move. One is, when and how will it impact the financials? And this is really interesting, I think, when you talk to the impairment piece, in terms of, and you're looking at scenarios. Well, you're testing against your best estimate against your carrying value today. Yes, there may be a risk, there may be a scenario, there may be something that changes in the future, but how do you assess what the financial impact of that is actually going to be? Because your carrying value in the future will be very different to your carrying value today. So there's a technical piece around that, I think, that is a challenge as you work through it. In terms of a suggestion, I mean, I think where we try and go, and where I try and go as much as possible, is external data points are very helpful. So point to market available information, external data points, maximize the use of that where you can, and just be very clear what your disclosure is, and more so what it isn't, and sort of make sure that that is explicit. And then I think they're the practical things that we would always look at when trying to do that.
Thanks, Steve. Rachel, what do you think?
I think I agree with everything Steve said, and I guess I'd add another example that came to mind as he was speaking as well. In many parts of accounting, in many parts of the financial statements and many accounting standards, we are expected to also disclose what's the impact of reasonably possible changes in assumptions. And if we think about the recent interest rate environment, for example, interest rates have gone up about 4% over the last 2 years. What does that mean for reasonable? What's a reasonable possible change in interest rates going forward? Another 1%, 2%, 3%. That's things like that are inherently speculative, and I'd say that's probably true of many types of forward-looking information, as Steve has also mentioned. I think agree with the 2 points around practical approaches. I'd say what we've disclosed in the market before external, it's definitely a consideration, and the big one is looking at other market information, external data points, to develop that expectation around what to disclose around forward-looking judgment. Judgments coming in the front half, and you mentioned the OFR. There's going to be a lot more information around how climate impacts our future prospects, our strategy to manage them, and to what extent are those considerations material for the financial statements. The materiality judgment in the front half is also investor focused and based on what primary users' needs are, but they may not be applied in exactly the same way in the back half when thinking about financial statements. And probably my last call out would be, you mentioned the ISB is working on a project on climate-related information within financial statements. As part of that, it would be actually extremely useful to have some application guidance with examples around when information as required by, say, the ISSB could be considered to be relevant and material for the back half, a bit like all the guidance that came out around COVID, for example.
Thanks, Rachel. Rachel, that's very timely comment, as the ISB is actually working on that project at the moment. Richard, so we have heard from the preparers, and now it's for your turn to give your perspective on this topic. And there are always questions about information being disclosed in the OFR, which is management commentary. Should they then be also linked to the financial statements if they're material? And even if it's not material, should preparers call out that they are immaterial and therefore there's no impact in the financial statements? There are a lot of questions. So perhaps, Richard, the first question is, do you get enough information in the financial statements about forward-looking information, about informations being disclosed in the management commentary?
Look, I think it's probably a case-by-case basis. It's very kind of hard to answer that in kind of a generic kind of sense. Look, I think, in my opinion, I think that there should be a distinction between the qualitative information in management commentary and and the information in the financial statements. I think many risks cannot be quantified. The future is inherently uncertain, and it's just not practical to provide a range of kind of scenarios across kind of a broad array of risks. And in many cases, the companies themselves, BHP and QBE do not know with certainty how kind of many risk factors will affect the financial position of those entities. It's the future is inherently uncertain. So I personally I don't really see a lot of benefit in linking kind of forward information provided in the commentary to the financial statements, just due to the inherent uncertainty.
Okay. So, and then Richard, can I also ask you a question on then? For your role is to predict and forecast earnings and cash flows, perhaps, of an entity. How do you then have an overall picture of an entity if the entity hasn't, they may have, but they haven't disclosed the risks information in the financial statements? How can they give you comfort they may have already incorporated those risks in the financial statements?
Well, I think something can be disclosed in a commentary as opposed to necessarily quantified, and reasonable people can take a different view on how to kind of quantify that, and it's always a kind of a range of scenarios. I guess the financial statements and the commentary kind of provide kind of one input, a very, very, very significant input into how we kind of think about forecasting cash flows. But we're using kind of information from customers, suppliers, competitors, kind of industry, a whole kind of variety of kind of sources to ultimately determine kind of what we think the cash flows of an entity might be on a forward-looking basis.
Okay. Thanks, Richard. Okay, so we now open up questions for audience to ask any questions you like. Please put your questions in the Q&A. I've got a question for Tom from David Hardridge. The question he has for you is, in a detailed materiality research paper, there was a very low reference by preparers and auditors to the needs of users. If they were not referring to users in their decisions, who were they considering?
Yeah, a very good question, Eric, and thanks, David, for the question. We saw a real split with auditors describing their materiality process on kind of where their motivation was coming from or what they were considering. So we had some did consider the users, and it was a fair portion that did. We had another group that were really more concerned about the audit process or the audit engagement in itself. So more thinking about audit risk and thinking about, with a particular misstatement, if they have to go back to the client and argue with them over whether a certain line item should be restated, how that might impact the audit engagement, the audit relationship with the client. So more thinking about their own motivations or that process of the audit rather than thinking about the user as a primary process. And then there was a group as well where it was very hard to tell really where it was coming from. That was kind of the group that really focused on that percentage-based threshold type view, really relying on their quantitative rules and quantitative thresholds, where more or less it seemed like it was kind of just a blanket rule they were applying and not necessarily really considering anything more than that. It was seen as very procedural, references as well to kind of prior year work papers and guidance given by an audit firm, where applying those kind of set quantitative rules is just the way that it's done. So yeah, a real variation, and that's really where that theme of variation in how materiality judgments are made came in.
Okay, thanks, Tom. And I guess that's the next question, which is also related to the question, is that I think there are some comments that we have heard that there's a gap in understanding the materiality concepts between stakeholders. And question to Marina, from your audit perspective, do you think there is a gap in understanding the materiality concepts between auditors, preparers, and users?
the simple answer is probably yes. I would say there is probably a bigger gap between with the users, which has been indicative of Tom's research. I would say that there's a less gap between the auditor and the preparers or the entities, because sometimes, you know, this materiality process, the entity goes through their own materiality judgment process, as does the auditor. But then there's a crossover as well, even though they may come to different positions. There's still I guess, a journey that they go on to determine materiality. Whereas with the users, I think it's more difficult. We want to be focused on the primary users, and some may say, well, that is investors if you're a publicly listed entity. Some may say that's broader for other entities. So I think there is a bigger gap there, definitely. And I guess, you know, with materiality, as I said before, materiality and risk assessment are the two biggest areas, you know, in an audit where a judgment is applied. So it is a very difficult area. I was somewhat surprised by Tom's research that there was 40% of very senior directors and audit partners that still obviously grapple with this concept. And I know we don't really want to talk about climate, but with the introduction of the climate reporting disclosures and our proposed international standard, this is going to be an area of further journey, let's just say, because as we talked about earlier, there's a lot of qualitative statements made around climate, and there are different considerations for the auditor when we're looking at qualitative statements. Auditors are supposed to look at qualitative as well as quantitative when they determine materiality. That's not a new thing. So, but I guess what's proposed in ISA 5000, which is the new international auditing standard, is that the auditor will have to determine materiality for quantitative disclosures. So that's a higher bar, and they will have to consider materiality for qualitative disclosures, which is a lower bar. So I think Steve mentioned it earlier, you know, when you've got a lot of different qualitative statements, whether they're in the OFR, whether they're in the annual report, or whether they're in the climate statement, it's hard sometimes to be able to aggregate if you've got different, I guess, groups of disclosures. You can't always aggregate when you're talking about qualitative disclosures. So that's a different concept too. When you're looking at quantitative materiality, it is easier to aggregate the quantum across the financial statements as a whole, and then also look at your performance materiality for your individual, you know, line items. So I hope that's answered your question.
Okay, no, that's helpful, and I'm interested to hear what Richard has to say as a user. Given that, Marina, you mentioned that there's so many users and different users, different investors wanting different things. Richard.
Look, I think in the vast majority of cases, I think users and auditors would obviously have a similar opinion on materiality issues. I think it's kind of the more, you know, very kind of nuanced, kind of context kind of dependent situations where we kind of might have different views, maybe like just picking one arbitrary kind of niche area. You know, in situations where there's maybe a controlling shareholder, an influential shareholder, or, you know, perhaps an externally managed entity, you know, one of the primary things users are trying to assess via the financial statements is, you know, how the economic benefits of that entity are going to ultimately be distributed to security holders. And so in that context, probably any kind of related party transaction is likely to be material, even if it doesn't meet some kind of quantitative threshold. So, you know, that's probably like one kind of example. You know, perhaps another example is that doesn't always kind of get disclosed is kind of contingent legal liabilities. Kind of, you know, particularly when a case kind of goes over multiple periods, you know, we seem to never be able to estimate what the contingent legal liability might be, and you know, the chance of that liability crystallizing changes, and, you know, we never kind of get any disclosure on that.
Thanks, Richard. And Tom, do you find the same comments in your research when you interviewed the auditors and other stakeholders?
Yeah, thanks, Eric. Like I said before, I think it's quite a variation that we see. To add an anecdote, when my co-author Michael and I were having a chat a year or two ago with a very senior audit partner back in Australia, and discussing this idea of materiality and this idea of, the different conceptualization of it between auditors and investors. We made that point from earlier that effectively the auditor is there to proxy for the materiality judgment of the investor or the user, because they can't make that judgment themselves. This is an audit partner, 30 years experience, and he made the comment of, oh, I've never actually thought of it in that way. So it definitely is an issue that's out there. It's that different conceptualization of kind of what's the role of materiality within these different areas and sections of the accounting system. But hopefully that's where something like practice statement 2, we can kind of see has that impact of getting people on that same page or that same level of materiality. And we've had discussions in our research around kind of the next step, maybe what is the solution? How do we bridge that gap, or where does that education come in? Is it something like looking at getting users and investors more involved somehow within the audit and preparation process of financial reports, so that we can actually better understand what their information needs are and we can facilitate more useful disclosures? That's an area that still needs more work, but I think, it's a very important topic around that conceptualization between our different players in the accounting system.
Thanks, Tom. I've got another question from the audience. The question from John asking, given the quantitative approach is used predominantly, is the assessment/judgment in most cases reasonable when the qualitative lens is added? I'm thinking to have this question for Marina to answer from the assurance perspective, because there's so many discussions about whether non-financial information or qualitative information can be audited reasonably. So perhaps Marina, do you want to share some of your insights?
Sure, thanks, Eric. Look, one thing I will say is that the auditors of financial statements are supposed to apply both quantitative and qualitative. So even though we're seeing, in Tom's research that it's predominantly around the quantum, the qualitative characteristics are supposed to be considered, and that's, written in our application material and our standard. So I just want to say that up front. So maybe not as much emphasis is being given to the qualitative lens. As I said, that will become, and I kind of keep going back into the climate space, but that will become, again, iterative and more prominent focus when we go through, when we get into a mandatory disclosure and assurance perspective on the climate stuff, because the qualitative material, it's actually specified in our proposed standard that you need to look at qualitative and make materiality judgments. And you may have multiple materialities depending on what information is disclosed if you can't aggregate it. So that's a concept that auditors will need to get more comfortable with as well. I'm just looking at the question. Yes, and what's the AUASB doing? So at the moment, the AUASB, and again, good or bad as it is, it's predominantly in the sort of sustainability climate space. We are looking at what else we need to do around materiality with this new standard coming out. And we've heard that from stakeholders when we went out on consultation recently, that they want more information about qualitative, quantitative materiality in that space. So we are looking at that at present, and we had a discussion with our board at our meeting on Wednesday. What that may or may not look like, can't really sort of, make that determination yet, but we're certainly geared up to be looking at some more guidance around that. So hopefully that'll be helpful to the auditors and the users and the preparers.
Thanks, Lorena. And it's interesting. Before the session started, I actually asked Steve because I realized that Stephen's role's been expanded not only on the accounting policy but also on the sustainability side of things. And the question that I had for Steve, and I hope he can answer this question for us, is given now the accountants and Steve would agree on this are expected in the future possibly to also have knowledge about sustainability reporting, and now. Steve, what are the challenges and what are your thoughts in terms of the interactions between you're putting a hat on the traditional accounting, financial reporting, materiality concepts, and also then going to interact with sustainability?
I think Eric, you've probably asked me the pertinent question of the moment, and one that I spend a lot of time thinking about at the moment, and therefore would not for a moment suggest that I have it solved or that we as an organization have it solved. I think it's it is a really interesting topic at the moment for a number of reasons. So let me just give you a couple of thoughts, but caveated in that we haven't solved it. So one is we and many other organizations have expanded and have enhanced our sustainability disclosures through the annual reporting suite in recent years to cover a whole range of topics. One of the interesting discussions going on at the moment, I think, is you don't want to go backwards from there. But there may be instances in which if you were to apply the materiality guidance that's coming through some of the sort of the evolving regimes or things like that, that you could theoretically end up in that position. And one example, I guess, there is if you look at the ISSB and the focus on users. Historically, a lot of organizations have thought much broader than users of the financials when they've determined what their material or significant sustainability topics are. Now, I would argue that if it's a topic that is significant to other stakeholders, ultimately it will be significant to users of the financials. But I think that's a debate that's going on in terms of how does that run through. I think the other obvious one is there are aspects of, and it's exactly what we've been talking about, there are aspects of sustainability and climate that ultimately in sort of pure dollar terms may be not significant in the context of an organization, but the impact on reputation, license to operate, investment attractiveness, access to finance, all of these questions around the progress that you're making on those agendas is material in the context of the overall organization. And I think it's ultimately it's how do we convey that? How do we understand what is material to those decision making without, and saying this a little bit flippantly, without doubling the length of an annual report. So I think that is the challenge that we as preparers certainly face over the next 2, 3, 4 years as these sort of standards come in, is how do we give that information without drowning the users in thousands of data points and saying, here you go, here's everything, you sift through it and try and build your story and your narrative out of that.
Very good. Thanks, Steve. And Rachel, do you have any thoughts on this too?
I hope and expect that more clarity will emerge around this topic, specifically around connectivity, because, yeah, Steve, as you said, I don't think anyone really has the answer around the exact answer on how they would be applied. I mean, the ISSB S1 basis for conclusions itself acknowledges that the materiality application, even though the user focus is the same, the materiality application around the climate reporting in the front half will I think the word is inevitably be different from how we would apply that same judgment in the financial statements. Like, because the front half climate disclosures would contemplate potentially risks and financial impacts over a much longer term than we would be required in financial statements. Or when I think about scenario analysis disclosures and climate resilience disclosures, might contemplate more extreme scenarios than what would probably be contemplated within, say, the recognition criteria of assets and liabilities on the balance sheet, or net zero commitments. If they don't meet the criteria for recognition of provisions, are they material in the context of financial statements? But they may be in the context of what the purpose of climate reporting is within the management commentary. So I guess what I'm trying to illustrate there is they're not the same, but how are they different? I think it's something that we all need to work through.
Okay, well, thanks, Rachel, and thanks, everyone. I think we should draw to the end of the panel discussions and in fact, the whole session, because the outcome from this conversation is that there's so much to think about on materiality. The topic's been talking for the last 50 years. We can see that this is going to the next topic in the next 50 years, perhaps. And as Rachel and Steve pointed out, now you need to think about how to interact with all other types of information, sustainability reporting, for example, and not to overload this information to from the user's perspective too, so that Richard, as a user, wouldn't get too much information and distract you on those important information that you should use for making decisions. So there are a lot of challenges. So I guess to wrap this up, I just want to thank Rachel, Richard, Marina, Steve for your insights in the panel discussion, and thank you, Tom, to share your research insights and your results with us. So one thing we know is that we must do more education session to educate our stakeholders about the management commentary, the PS2, which is the materiality practice statements. I think that's really important. With that, I'm going to close this session, and thank you everyone to attend the session. We hope to see you next year again. We'll have a series of dialogue series again next year with a lot of different topics, and we'll provide those details in early next year. That's all for everyone. Thank you, and have a good Friday and a good weekend. Thank you, everyone.